right, let's talk about investing. We're going to go on a little quest to unpack one of the simplest, but honestly, one of the most powerful ways to build wealth: index fund investing. You ever look at the stock market and just think, wow, that is a complicated game, and I don't even know the rules? A lot of people feel that way, like they're just sitting on the sidelines. But what if I told you there's a super straightforward path? One that's basically designed for beginners and has an incredible track record of success. Okay, let's get right into it. In this first part of our quest, we are going to pull back the curtain on the single most powerful tool for anyone just starting out. So, what on earth is an index fund? Well, imagine the entire US stock market is one giant pizza. Now, instead of trying to guess which single slice, which company is going to be the tastiest, an index fund just lets you buy a tiny piece of the entire pizza. You get to own a small part of hundreds, sometimes thousands of companies all at once. You're not trying to be a genius stock picker, you're just grabbing onto the power of the whole market. And this right here is why this is such a game changer. It's simple, right? You don't have to become some stock picking wizard. It's super low cost, so fees aren't just eating up all your returns. It's automatically diversified, which basically means if one company has a bad day, it doesn't sink your whole ship. And this is the best part. This ridiculously simple strategy has historically beaten the pants off of most highly paid experts over the long run. And look, you don't have to take my word for it. This is from Warren Buffett, arguably one of the greatest investors of all time. When a guy like that tells you this is the most sensible path for most people, you really ought to listen. All right, so you get the secret weapon now. Let's move on to the practical stuff, the actual tools you're going to need to get started on your quest.
So you're going to see two main flavors of these things: mutual funds and ETFs. Think of them like two different paths that lead to the exact same castle. Mutual funds, they're awesome for setting up automatic recurring investments, like take X dollars out of my account every month. ETFs trade a bit more like individual stocks throughout the day. But here's the crucial point, and you can see it right there on the screen. Don't get stuck on this. Seriously, for a beginner, either one is going to work perfectly fine. Just pick whichever one your brokerage makes easier for you.
Okay, so what do you actually invest in? Well, believe it or not, you can build an incredibly powerful, globally diversified portfolio with just these three building blocks. You get a fund for the US stock market, another one for companies all over the rest of the world, and then a bond fund. Bonds are just a safer, more stable investment that helps cushion your portfolio when the stock market gets a little, well, rocky. And check this out. This shows you just how easy it can be. You want to be as simple as possible? Go with option 1. Put everything into a single total stock market fund, and you're done. Seriously. Want a little more diversification? Go with option 2, a simple mix of those three funds we just talked about. That's it. You don't need some complex, fancy strategy. Okay, we have our tools. Now let's talk about the actual strategy. Because this isn't a get-rich-quick scheme. No, this is a get-wealthy slowly and steadily plan that really works its magic over decades. This is the question, isn't it? This is the one that stops so many people before they even start. They think they need thousands and thousands of dollars to make any real difference. But what if the real power isn't in how much you start with, but in just being consistent? Look at that number. $113,000. You know what that is? That's the potential result of investing just $100 a month for 30 years, assuming an average market return. This isn't magic. It's the incredible power of time and compound growth. Starting early, even small, matters so much more than starting big later on. And if you only take one single thing away from this entire explainer, please let it be this: don't try to guess when the market's going to go up or down. Nobody, and I mean nobody, can do that consistently. The winning strategy is just to invest consistently and stay invested. Let time do all the heavy lifting for you. So you might be wondering, where does the money actually come from? Well, it's pretty simple, really. It's a two-part thing. First, as those hundreds of companies you own grow and become more valuable, the value of your investment grows with them. And second, a lot of those companies will actually share their profits directly with you. They're called dividends, and you can just reinvest them to buy even more. It's a beautiful thing. Every hero's quest has its traps, its monsters, its pitfalls. And in investing, these monsters are the little behavioral traps that can totally sabotage your progress. So let's learn how to spot them and, more importantly, how to avoid them. And here they are, the 5 big wealth destroyers. Trying to be a market psychic, obsessively checking your balance every single day, jumping on whatever the hot new trend is, building some crazy 20-fund monstrosity of a portfolio. All of these are just distractions from the simple winning path. But the biggest, baddest monster of them all? It's panic selling. Look, market crashes are a normal, totally expected part of investing. They feel terrifying, I get it, but selling when everyone else is scared is literally how you lock in your losses and miss the big recovery that always follows. Your job during a downturn? It's to do absolutely nothing. Okay, let's talk about one little trap that can do some real damage over time: fees. The main one you need to look out for is called the expense ratio. It's a tiny little percentage, but it really adds up over decades. Your goal is super simple. Find index funds with an expense ratio below 0.10%. You can find plenty that are even as low as 0.02%, which is just fantastic. All right, we've learned the strategy. We've learned how to avoid the traps. Now for the final leg of our quest, embracing the mindset that actually leads to victory. And, spoiler alert, it's delightfully boring. This right here is the champion's mindset. You're not a day trader. You're a long-term owner. So you need to think in decades, not days. You put your savings on autopilot so you don't even have to think about it. You stay boring, you stay consistent, and you learn to tune out all that 24/7 news hype that's just designed to make you panic. And this really gets to the heart of it. The whole financial world wants you to believe that investing has to be exciting and complex. It really, really doesn't. Your portfolio should not be your source of entertainment. The most effective path is the one you can just set, forget, and let grow quietly in the background for years and years. So, there you have it. The map is in your hands now. You've got the tools, you've got the strategy. The path is simple, it's proven, and it's accessible to absolutely everyone. Your quest is just getting started. The only question left is, what could your boring path build?